Hope you're standing by, you're there with us as we've just put some finishing touches on what we've got to present tonight. We have a lot to get through. We're talking small caps, the thing that everyone likes to do, or at least not everyone actually. I shouldn't get ahead of myself. Only 68% of people in the live chat have said that they do invest in small cap shares or like to invest. That means about 1/3 of folks are saying no thanks. I love to invest in small cap shares. I love to invest in private companies, smaller companies. I just think it's really interesting all around. So delighted to have Rob Miller on the show tonight. But before we get to him, I've got a few things that I would like to just share. And if I just bring up my screen now, I'll be able to do that. So this happened yesterday. For those of you that aren't on Twitter or don't listen to Bloomberg or read the financial news every single day, you might have seen this. So this is maybe not my joke of the week, but it's kind of up there. Elon Musk, you may remember, attempted to buy Twitter, then through a bunch of argy-bargy, pretty much called the deal off. And now it seems it's back on because more of his text messages and emails were probably going to be brought out. And it seems that he's chosen the higher ground of maybe we will just do the acquisition and see how we go. So Twitter shares jumped, I think, 22% today. Let's see if I can get this up. I think they're up 22%. So 22% being yesterday. But a bit of news happening in the sphere of global technology. So I just got to say, if you are there and you're lurking, you're watching, say good day in the chat. I can see a bunch of us have already done that. G'day, Brett. Good evening to you. I'm assuming it's evening, or you're just saying evening to us. But I'm assuming it's good evening to you too. So welcome to tonight's Selfwealth Live. Before I go on, as always, don't forget that any of the information that we include tonight is limited to general financial information only. We don't know your personal circumstance, and that's what you need to see a financial planner for, to go into depth about your personal circumstances and give you one-on-one advice. When we talk about investing, we're talking about it in a general nature, and even when we answer your questions. So I'm joined behind the keyboard tonight by Randini from Selfwealth. So if you see the Selfwealth moniker in the live chat, it could be either one of us. We'll do our giveaway after we've spoken to Rob tonight. So please have your guesses ready. Your top 5 most bought, your top 5 most sold is what we'll go through. And I just want that number 1. What's the most bought and what's the most sold? Keep them handy. We will get to them after we chat to Rob. Rob's got a bit of a presentation we're going to go through. He's going to name his 2 companies, and then we'll go from there. So I'll bring Rob on in just a moment, but just a bit of an introduction to Rob. I was lucky enough to catch up with him a couple of weeks ago, but Rob joined NAOS Asset Management in September 2009. What a time that would have been. 2009, if you haven't been playing the game that long, you may remember just through reading or through hearing about it, that was the GFC. So that was in the thick of things. Rob joined NAOS as an investment analyst, and since 2014 has been a portfolio manager. And you can see here that he works across the emerging companies, the small opportunities companies, and the X50s. So he's a specialist in small and mid-cap Australian companies. And so I think he's going to be a great guest on the show tonight. Please, we will get to your questions. That will probably come in about 20 minutes or so. I'll maybe prompt Rob with a few things. But without further ado, let's bring Rob into the show. Rob, it is my pleasure to welcome you to Selfwealth Live, mate. Good to have you with us.
Yeah, thanks, Owen. Evening all, and I appreciate you having me on the show. I'm looking forward to it.
Yeah, mate. We're having a bit of a connection issue, but that's okay. Don't let us slow us down. I just mentioned there you joined NAOS in 2009. Can you take a moment just to tell us how did that come to be in the GFC? Thick of things. Like, how did you land the job at NAOS?
Yeah, sure. Geez, it's ancient history for me now. So you take it back, but basically, through a family friend of mine, I was lucky enough to have a coffee with at the time. It was a very young bunch of fund management business at the time. Very young guys working there. there's only a few. There wasn't much left of what was around from the pre-GFC times, and I joined at probably arguably the best possible time if you're very wet behind the ears to join any sort of business is in an absolute crisis period or just on the back end of it. And so I didn't get the highs and lows of before. I just got the lows to start with, and I suppose that's provided everyone at NAOS a bit of a grounding for kind of where we were born out of. Was kind of born out of the GFC. So we certainly do remember those times. They were very dark times for everyone across the world in many aspects. But it was an interesting time to join, and I'm very thankful I got the opportunity back then.
Yeah, it's interesting, right? When we look back with hindsight, it's one of those things where we look back in hindsight and we think to ourselves, that would have been a great time to invest. But then when we look forward to those times, we think we're going to avoid them at all costs. And it's a funny bit of psychology where we're fearful of the next market crash. But then when we look back, we're so, overcome with emotion about like, oh, that would have been such a great time to invest. So you can see it from the perspective of, it doesn't matter what happened last year. I'm here on, day one, joining NAOS and getting my start in the industry, which is fantastic. So, mate, why don't we dive into the companies? Tell us a little bit about NAOS itself, and then maybe we can start to go through these companies. If you have any questions, I can see Umbrella Lemming, you've commented in the chat, and Megan, hi from Perth. If you have any questions for Rob as we go through, please do reach out. As always, we've got a bit of a disclaimer here. But Rob, I'll be guided by you, and maybe I'll just ask some questions as we go through. Yeah,
that sounds great. And I'll just echo that disclaimer. Anything I say will certainly general in advice, and everyone can do their own research. And there's a disclaimer there to read on our website should you wish to look further. So just very quickly before the meat of everyone's reason for being here, I suppose, is to see what stock tips I've got for today. But just before that, I might just give a quick background on who we are at NAOS. And as Owen alluded to there, we're kind of born out of the GFC around that period of time. But effectively what we are is we're an Australian boutique based in Sydney, and we are specialists in small and micro cap businesses. The structure in which we run is listed investment company structure. So for us, that provides us with an excellent vehicle to take long-term positions in businesses and not have the risk of capital calls and applications and redemptions, which very much suits our style that I'll touch on shortly. We're a small team of 10, as I said, smaller micro caps, and we also do private businesses as well in terms of where we invest at the moment. So that's our bread and butter. And if you come to the next slide, I'll talk briefly about who we are as in terms of our investment process and the beliefs that we have. And I think the keys for us is quality over quantity. So you might hear that from a lot of people, and that's very true from others to say it as well. But when we say quality over quantity, we're very concentrated in what we do, and we believe that's I suppose a multitude of things relating to the opportunity set of what we find as quality and what we perceive to be high quality investments is small. And when we do find those businesses, we want to take very meaningful stakes. So it's not uncommon to see us on the register of a small or micro cap business with a 20% holding in a business. One of them I'll talk about tonight. Furthermore, we're a long-term investor. As I said, we've got that listed investment company vehicle structure, which allows us to take very long-term views. And for us, if we're not looking to take a 5-year view in a business at the very minimum, it's probably not something that we're really going to spend a whole lot of time understanding and therefore investing in. I think as well, we're very much focused on real businesses and real people behind those businesses. So management alignment is extremely important to us. Skin in the game is one thing, but it's also the culture that these particular CEOs and the wider team around them build. And I think anyone who invests in smaller micro cap businesses, there's plenty of you on this presentation tonight. The keys in businesses that are small are the people. There's a very few people at the top, and they make an extraordinary influence on the wider business over a long period of time. So for us, that's very key. And alignment isn't just related to financial. We're very big believers in ESG, and we think alignment between ourselves, our community, and the businesses that we invest in is very important. And equally, we're not just a passive shareholder as well. We're not an activist. We look to provide constructive engagement with businesses that we invest in, and we do that on a regular basis. So We do take board seats occasionally, and certainly doing that more over time. But it's a lot of other soft areas which we think we can add value. So we're not just a financial sponsor. We look to add more over time with that process.
Rob, can I just butt in for a second?
Sure.
On the previous slide, you said that 1% of recurring revenue goes to organizations. I didn't know that. Maybe I did and I just forgot. That's pretty special.
Yeah, it's something we've been doing for a few years now, the 1% pledge. So we take 1% of our recurring revenue, our time, and our intellect, and we look to give that back in numerous shapes and forms. When it comes to specifically the comment there, where there's 4 charities that we provide. We pay back what we can in terms of donations and help out where we can, and that certainly comes from a revenue line, not just a profit line in our business. So it is quite material, especially for a small business like us. So
yeah, it's fantastic.
Yeah. So that's pretty much a very high level snapshot on who we are at NAOS. As we've kind of discussed, been doing this for a little while, and what I would say is FY22, if we come to the next slide, Owen, FY22 was a very challenging year and a very interesting year in the context of certainly my career, and I'd say probably wider, a lot of investors that have that similar view. And I put this slide in probably more so to highlight the change that happened over FY22. And I mean, I'm stating the obvious here, so I won't dwell on it too long, but clearly there's been a significant macroeconomic change throughout the year of FY22. Capital markets and equity is no longer cheap. Capital and free money it's no longer allowed. It's a thing of the past. And with that comes significant ramifications across all sorts of industries, right? So we've seen, I even saw something today where I saw the amount of technology businesses that are now making that switch from focusing on growth at all costs to positive cash flow can't come soon enough, I think is actually quite telling. It's a telling time of the sign of the times at the moment. And I think this slide here, what I'm trying to show is, whilst Amazon is no doubt one of the best businesses on the planet, I suppose 12 months ago, a treasury note was giving you a yield of probably sub 1%. And I suppose that's forcing people into equity markets and rising valuations, which drove up, significant asset prices and bubbles in certain areas of the equity markets. Not least the FANG stocks for a while there as well. But what I'm trying to say here is that now we've actually got a reasonable alternative in, you're getting paid to hold treasury yields now at 4%, arguably. Has that changed going forward the paradigm of how investors look at all businesses? And I think it has slightly, and furthermore, it has got more to play out. But what would you buy today? I mean, I'm not saying that I wouldn't buy Amazon on 53 times PE, but in terms of the income profile you get out of a T-bill now, as an example, it is quite compelling, especially when you compare it to 12 months ago.
So, Rob, just for folks that don't understand maybe the implications of this, from an analyst perspective, can you just explain maybe kind of that trade-off for an analyst as well as an investor, like what impact this has?
Yeah, of course. So I mean, at a very theoretical level, all asset prices are kind of baked off the risk-free rate, and the risk-free rate is effectively determined by the interest rates that are set by the central banks around the world. And clearly, when they go up, the risk-free rate goes up, and therefore the price that you're willing to pay for a riskier asset like equities is commensurate to that risk-free rate. So when you're seeing a risk-free rate very, very low and you want to get a return on your money, equity markets are a fantastic place to be, because the search for yield and the search for returns drives you away typically from income producing things into areas where you're going to get more capital growth and gain over time. Now, when you've got a risk-free rate that's rising, therefore the alternatives to equity markets become more appealing. And I'm sitting here as an equity specialist, as we all are on this call, and I'm certainly not discounting equities over the longer period of time, but I'm just here to highlight that the alternatives out there have changed and have improved to a certain degree. So therefore, how do we combat that, and how do we change our thinking as investors in equity markets? I think that's what you're seeing, different companies and different industries and sectors and types of businesses becoming more in vogue over a longer period of time now that we've got a new normal, let's say.
Yeah, I agree. We can see that playing out with like the growth stocks of last year, like some of those names in US names in particular, like, you know, companies like Zoom and all the growth stocks of last year. I mean, Peloton, all those things that did well during the COVID period as well have just come way off, not only because of their business models, but because of that appetite shifting, right? So, yeah, it swung a big way.
Yeah, absolutely. So enough about what was, and I suppose more importantly is how we're thinking about the current markets and our current positioning as the businesses that we invest in. And, you know, at the end of the day, we are equity market investors in small, micro cap and private businesses. That's what we're paid to do, and that's our specialty. So we're going to continue to do that if we can find the right businesses and good things to buy throughout any cycle. And there's always opportunities. It's just how you find them and think about them over a longer period of time. So if you come to the next slide, a few kind of key ways that we just generally think about investing is we always want to be doing it behind industry tailwinds. And that might sound really obvious, and it's probably something everyone wants to do. But when you are investing behind industry tailwinds, you're not fighting the tide. You don't have one hand tied behind your back. You're fundamentally set up for growth, and the businesses then can grow within growing industries, and you should be able to get a compounding effect in theory over time. So a few of the key ones that we at NAOS are big believers in, and we've done a lot of work, I suppose, on stress testing and understanding why we're big believers in these is, well, firstly, residential property shortages. None of this is new. So everyone knows, everyone who reads a paper can tell that there's property shortages, in Australia. And I suppose this has a two-pronged effect, I should say, is it means that the construction cycle that many have feared is somewhat over, let's say at the peak. It's actually probably got a lot more to run in terms of consistency over time. Add to that immigration, and add to that further when you think about aged care and aged living and independent living over time for seniors, that kind of baby boomer and beyond, the more and more people that transition into that senior area of, let's say 65 plus, the percentage ownership of housing, home ownership, I should say, has drastically fallen over the past 20 years from, I think in the 55 to 65 category, it's gone from, 70s to close to 40%. And all those people need homes. They need to live somewhere when they're retired and on the pension. So we're thinking about businesses, and we've got some in the portfolio that should benefit from probably a longer term bullish view on the requirement for housing and the requirement for housing in certain areas, whereas others in the market might not be as bullish as us on that area.
Rob, I've got a question that's just come through from Martin. It says, is healthcare one of the tailwinds that you've identified, or is that maybe something else? How do you think about that?
Certainly, healthcare is a tailwind, and I mean, I think it's it kind of goes in bipartisan with an aging population. Clearly, that's going to drive more health outcomes across the economy, and ways to come up with solutions that are going to be less of a drag on the kind of central, our central balance sheet as a country. So very much so. We're not experts in medical areas. We do have an investment in medical device distribution business where we're not picking a winner. We're simply picking a trend to some degree. But aged care is obviously another one. Again, we don't play in that space because of the regulation. Is very, very kind of fluid, and we're sticking in our views in the aged care and in the aged sector is to an independent seniors living group that benefits from all of those trends I've just talked about. And then I'll jump in terms of the other kind of key tailwinds there. I'll talk about two shortly: the renewable energy transition and kind of the aging and complexity of the vehicle fleets when I come to the two companies that I'm going to talk about. But the last one there I just want to highlight very quickly is that kind of business de-risking of supply chains. So we all know supply chains have been a huge issue over the past 12, 18 months for everyone across the globe. And that whole notion of onshoring again and bringing back domestic manufacturing and more capability internally, clearly that drives a very different profile of supply chain and the requirement for more transport, logistics, trucking, things to moving from A to B, import, export. All of those factors, I think, are very, very crucial to underpinning what would be an onshoring of supply chains, and we've got an investment in that space through a company called Move Logistics, which is born and raised out of New Zealand. Think of the Mainfreights of the world. All of these businesses, Mainfreight's arguably one of the best listed businesses in Australia and New Zealand. We think that if Move Logistics can do 1/10 of what Mainfreight can do over the next 10 years, it's going to be a great business, and it's got the people behind it, ex-Mainfreight people who have demonstrated the track record at Mainfreight, and we think they can do somewhat of that again at Move Logistics.
Is that listed, Rob?
It is actually. It's listed in New Zealand, and it actually just recently dual listed in Australia in the last couple of months. So the stock code is MOV.
Oh, right. Yes, I have seen this.
It's a small little business, but one that's undergoing a turnaround off an old management into a new management team, as I said, that's come out of Mainfreight. Dual listed, so it's probably going to get it's opened itself up to a wider investment audience by obviously dual listing on the ASX of late.
I actually see that, Rob. I've spoken to some investors earlier this week, and I've heard a couple of them say that they are very mindful of this. Some people have called it like the opposite of globalization, right? But companies wanting to make sure their supply chains are rock solid, and countries too wanting to make sure that companies have sorted that out, right? So having more manufacturing in Australia, having more supply lines in Australia, these companies. So that's really interesting. You guys have identified that and are already moving on that. No pun intended.
Yeah, exactly right. That's and you see that I suppose peak of globalization. That's a common thing, and we've seen it from rhetoric out of politicians globally. We've seen it out of key business leaders globally that's the case, and there's no point fighting it because it's happening. And so how can we as a country benefit, and how can we as investors benefit from that as well?
For sure.
So coming to probably the kind of meat and potatoes of this, and I'm going to talk about two particular companies today that are very much micro cap businesses, and obviously I'll caveat that we are substantial shareholders in both of these. So as I said with a disclaimer, take everything I say with a grain of salt. Do your own research. Obviously, I'll highlight the risks, but certainly this is only general in nature. But coming to Maxiparts first and foremost. So this is a truck and trailer and kind of bus replacement parts, aftermarket parts vehicle provider. So think about, I'm sure we've all been into a Bapcor or a Burson or a Super Cheap Auto or something, and a lot of the equipment that you buy on the shelves, it's not, it's secondhand. It's aftermarket. So you're not getting the original. You're not getting an original Ford replacement. You're getting a like for like replacement that's a hell of a lot cheaper. And what Maxiparts do is this, but in heavier vehicles. So there's three key players in this space in Australia that control about 30% market share. Maxiparts, Burson's through one of their subsidiaries, and a business called Supplier Networks, which I'll touch on shortly. But the key, I suppose the real key behind this business is investors on the call might remember a listed company called Maxitrans. So that was a parent group of Maxiparts plus a trailer business, a trailer building business. So when you think about, you see a B double on the road, the trailers that are on the back of those trucks were actually built by these wider parent company as well. And this is a business we've been looking at for many years, but there was a key catalyst that happened last year that actually made it, in our opinion, investable again. And that was actually divesting the loss-making, capital-heavy trailer manufacturing business. And now what's left is a capital-light parts distributor that has nationwide presence and is one of the leaders in their space in the country. And that, I think, is a huge change for this business. It's been rebranded. It's got, as I said, significant market share between the three largest players. They are dominating, and they're continuing to take market share as a group as the sector continues to grow. So it's basically everything. If you're a truck or a fleet operator, everything you would need and spares and replacement parts. This is all very crucial stuff to your business, because if that truck isn't on the road, you're not earning revenue for your business. And every day a truck's off the road is loss of potential opportunity of revenue. So having parts and replacement parts that are accessible and can be delivered to you very quickly is extremely important. So a moat to this business is scale, and also having the customer relationships for them to call you in their time of need, which is very regularly, and giving them the parts just in time for when they want it.
Mm-hmm. So this the business that they spun off, Rob, is that business listed, or is that now a private business, or what happened to that?
Yeah, no, it's a private business. It was sold to a private group, and for I think about $13 or $14 million last year. There's still a relationship there where they source parts off each other, but for all intents and purposes, that business is well and truly gone out of the what is left of Maxiparts, which is, as I said, a very capital light business. That if you look at the comparables, this business has been extremely underinvested in, and effectively the unloved child in the parent group for quite some period of time. It's now being liberated out of it, and under the current management team of Peter and his team there, he knows this industry extremely well. We just think a reversion back to normal for this business is extremely healthy for potentially healthy for shareholders and investors over the kind of medium to longer term. Sorry, you go.
So I was going to say, you can see it here, and this is one of the issues with looking with historical financials, right? Because you can see here the revenue's dropped off a long way, but gross profit not nearly as much. So highlighting what you said, like it's probably a better quality business now that it's sold that, even though it may be smaller in revenue terms.
Yeah, and it's not a shrink to greatness, but it's a shrink to something better than what it was. And if you look at the best comparable for this business is another listed company called Supply Networks that operates a group called Multi-Spares as their operating business. Supply Networks, for anyone who doesn't know, is a $400 million business, I think, from memory, and it's an excellent run truck and trailer and replacement parts business that is on its margins are well and truly double of what Maxiparts is. Its return on equity return on equity metrics are kind of 30-40%. It's been a great business for a long time, but in our opinion, it's also priced like one, which is fine. But when we look at Maxiparts, we think the opportunity there is to not necessarily be. I'm not saying they're going to be producing the return on equity metrics of Supply Networks tomorrow, but I think the trajectory of improvement over time for this business is very, very, very understandable and very achievable. And you think about that in the context of, well, if we come to the next slide, just there, this is one I just put in because I think it's telling on what's happened kind of throughout COVID and the transition out of COVID. Is we all know that how expensive used cars are in Australia. But why is that? It's because we're not getting any new cars into the country. So what does that mean? We've got a continual aging of the vehicles. The 20 million vehicles that are on the road in Australia. And what that effectively means is the older vehicles are, the more maintenance they're going to require, the more replacement parts they're going to need, and the more complexity as you do get new vehicles into the country that are higher technology over time, even electric vehicles in our opinion, and hydrogen. All of these hydrogen engines, electric engines, they've got even more complexity to them. So over time, you've got a continual aging plus more complexity with technology coming into the market. All of that, in our opinion, bodes very well for requirements for replacement parts for trucks and light commercial vehicles over the medium to longer term.
Rob, I've just had a question come through from Tarwin, who asks, do you always look for capital light businesses in the small cap space?
Not, yeah. I mean, yeah, we do certainly look for capital light businesses. Sometimes they're harder to find than not. But yeah, in our opinion, if you really want to compound capital well over time, you can do that best through capital light businesses that over time should, be low debt businesses that can produce a lot of free cash flow. So that's certainly what we look to target across a wide range of sectors and industries. But yeah, we've got some key kind of hurdles that we look for in any business, which includes capital light nature.
So Rob, if you're looking at Maxiparts, I imagine a lot of people tonight, including myself, will put Maxipart on our watch list. What are some of the things that you're looking at? And these may be like good things, or like milestones, or even like risks. If you think that like your thesis is broken or something like that.
Yep, no, of course. So I think the key milestones, firstly, is, which is also a risk, is they, as I said before, they're effectively a liberated business now on their own. And with that comes risk, and execution risk is key with this business. They've also made an acquisition of late in that kind of Japanese truck part area. So the light commercial vehicles that you see, the Zuzus.
I'm wondering what this was up the top. Right? Yeah.
That's a very much a growing area in the industry, and Maxiparts are now participating in that. So I think a key milestone for us is actually integrating that business well, which I think they're on the way to do, but also just getting some consistency and cadence of being a listed business on their own and producing some good financial results is key to kind of de-risking this even further and producing improved margins over time. In terms of risks, yeah, competitive risk, definitely. As I said, there's three major players that have about 30% of the market. They do operate in slightly different areas. One focuses more on buses and the other, let's say, some have more European part focus as opposed to Japanese and American and whatnot. But fundamentally, if one of them decided to, let's say, completely undercut for whatever reason, to try and drive market share, that may be a factor. But equally as well, when you've only got combined group of 30% market share across the top three, there's still a lot of white space to grow in.
Yeah.
The other major risk might be that, in our opinion, we might have got the thesis horribly wrong on, I suppose, on electric vehicles just generally. Maybe they don't require any maintenance, and maybe there is no complexity over time with trucks, or the transition happens quicker. I don't think that's the case from what we can understand. Is there is more complexity, and there will be a lot of period of time where there are hybrid, diesel engine trucks and and buses out there. But that if cars and trucks and trailers and whatnot no longer need replacement parts, then that's obviously this business would be hindered by that. But doesn't seem likely in our opinion.
It's interesting, mate. Like this is the first time we've made a foray into small caps. Like we've spoken to Andrew Page from Strawman about it a little bit, but this is a really like classical small cap business, right? Like a business that will fly under the radar of so many investors. So I think it's really interesting that you bring this on the show. When it's actually a question about, because you said before, like, you're concentrated in the way you invest at NAOS. How long do you hold like a typical investment to watch the thesis play out, I guess?
Yeah. I mean, in theory, if the thesis plays out well, we can hold it for forever, right? But I mean, that's reality is a different beast. Some we've held since, let's say, 2015 onwards. We've got some in the portfolio, maybe even a little bit earlier. For us, we really want to go well north of doubling our money over a 5-year period, probably more like a 3-year period in terms of the way we think about a compound growth rate. But there's no reason why, let's say, a business like Maxiparts doesn't continue to produce compounded returns over time, that we wouldn't be an investor for a long period of time. And I say that with respect to, if you look at supply networks, that's been a great business to invest in for 10 plus years. So if you find good ones, ideally you don't have to sell them for tomorrow for any reason. But in saying that, look, I would say when we think about them, generally, as I said at the start, a 5-year profile is what we're thinking in our heads. So,
I just had, maybe before we get on to the final company, there's one more question that's come through, which is Maxiparts an acquisition target? Like, is the risk that it gets bought out too soon by, say, like Bapcor or someone like that?
Yeah, I mean, I can't sit here and speculate on kind of what ifs when it comes to M&A, but it is possible that someone sees the attractiveness of this distribution network and the turnaround that can continue to happen over time, and likes, wants to take it private or acquire it. Yeah, Bapcor has been an acquisitive business in the past, but the sector has largely consolidated to a degree. So yeah, we'll wait and see, but it's a possible outcome for sure.
Yeah, for sure. And I guess the risk there, that was from Martin, the risk is that your company gets bought out for a premium, which is normally good. It's normally a good thing in the short term, maybe not over the long term if you do think it's long term undervalued, but it can be a good problem to have sometimes, mate. So how about your second company, mate? I'm sure.
Yeah, just obviously conscious of investors' time on the call. So I'll quickly skip through our second business here called Gentrack, which is again it's a dual listed business again. What they do is it's a utility billing, customer billing software platform. So think about, I'm sure everyone on the call has opened up their electricity bill of late and gone, wow, that's probably more than what I thought it was. So the software behind how I suppose you receive that bill and customers interact with the kind of retail providers is through billing systems and software that is absolutely crucial to any sort of energy retailer. If you don't get paid by your customers, then you don't have any revenue coming in the door. So Gentrack it's actually quite an established business. It's been around for quite some period of time. Why I'm sitting here today talking about it is it had a bit of a fall from grace about kind of 3, 4, 5 years ago, and business we've been following since IPO in 2015, I think it was. We were previously investors. We sold out, and then fortunately, kind of missed that down profile there. But Gentrack's got a new management in place, new management team that's, in our opinion, extremely highly credentialed, and we've background checked that quite extensively out of a larger US listed business called Amdocs. This business has had a technology refresh, which was kind of complete last week, and it's about the three kind of tailwinds for this business are. The digital transformation of a lot of energy retailers has still to occur. A lot of them are sitting on legacy SAP and Oracle platforms, and a requirement to upgrade and improve their systems is necessary. The cost to serve continues to, I suppose, be needed to drive further down and lower. And the way to do that is through technology and processes and systems that you can streamline. And the third major one, I think, here is the complexity of the energy markets just generally, and our day-to-day interaction is extremely complicated and only getting more complicated. So if quickly, and we switch to the next slide for 1 second, I'll just show you this diagram here, which is I'm trying to, I suppose, illustrate the fact that if you're sitting in your house, and not myself, perhaps Owen, and he's got a nice Tesla in the garage, and
don't know about
that, and there's that ability now to kind of give back energy into the grid as things become smarter over time. And when you give back energy into the grid, then you should be deducted from your bill for that, right? So how does that offset in the tariff profile? That's a whole lot of complexity that hasn't been required in the past in let's call it a kind of analog energy market world. The way you do that is by technology systems and billing platforms that allow you to know what tariffs to charge, what to discount people, etc., and so on and so forth. So this is effectively the fundamental reason why new age and new generation software is required with all energy retailers going forward. And Gentrack have a strong profile in Australia, New Zealand, the UK, which I can talk about in the risks shortly. But that's kind of the bread and butter of this business in terms of tailwinds. And we think under the current management team, it's priced like it's going backwards, but the business is certainly finished its kind of turnaround. It's on the net balance sheet. Expenses all are in the end. We think it's on the right trajectory now.
I've got one question myself, Rob, and another question coming from Tarwin. Maybe we'll get to Tarwin's first, which is, does Gentrack overlap with Energy One?
Yeah, I don't know Energy One as well as I do Gentrack, but it doesn't. Energy One's used by more. I know they've got different modules, but it's more used by the traders, whereas this is the actual back end of the billing system and software that is customer facing rather than necessarily being an energy trader. So they are different businesses. It's more similar to like a Hanson or something like that, which investors may be aware of out there.
Yeah, Hanson doing the telecommunications billing for of all telcos. Yeah, that's probably the way to think about it. Good question, Tywin. My question, Rob, was actually more around. So you said you held it before, like from IPO, and then before it crashed, and then obviously bought back in recently. What I'm trying to remember, because I followed it quite closely as it rose, but I can't remember exactly what went wrong with it.
Yeah, so it probably got ahead of itself in the sense that it was still an on-premise software provider back then. It started capitalizing its research and development spend, which for us, when a business that has never done that starts to do it, it's a very big red flag. So we saw that, and that was our cue to exit. That was probably in 2017, 18. What happened there subsequently is there was just project delays. There was mess ups on implementation, and the management team at the time, unfortunately, probably weren't up to scratch when it came to fixing the issues, and it basically went into free fall because the business was unable to provide solid financial information to the investment market, and they continually lost customers, and it really kind of was underinvested in for a period of time there, and it kind of went astray. But we believe that's changed quite drastically now.
So as we turn to risks now, quickly, would that be one of the risks then? Like, I guess a repeat of that, or is that something that's not going to happen?
To be honest, I think that kind of risk is in the past because they've caught up on their investment spend and made this business a far more leaner, more agile business for the 21st century of technology required for utilities. I think the major risk here, which has almost already played out and is kind of, if we were sitting here 12 months ago, it's a significant risk, is the volatility in the energy markets where, if any investors have kind of read about what's happened in the UK, as an example, has had a terrible time in the sense that energy retailers continually went out of business because the energy price caps that they're allowed to charge customers was far lower than the price of energy itself. Let's say electricity was trading at whatever it was, they were only able to charge their customers, let's say, half of that. So, when your costs are bigger than what you can charge, it's a recipe for disaster. And Gentrack actually saw a significant amount of their customers go out of business. That became, they went into administration. That has effectively stopped now in the UK because the UK government has stepped in and they've raised the caps that you're allowed to charge your consumers. Firstly, and that continues to rise over time. But secondly, they're not letting any more energy retailers go broke. So what we've probably left with now is fewer and fitter and stronger businesses. And Gentrack, whilst they lost a lot of customers, they lost a lot of revenue in that period of time. That's largely kind of flowing through now or done. And even with that, I think what probably the most pleasing part from our perspective is, despite that happening over kind of FY21 and FY22, they actually upgraded and beat their financial guidance for FY22 because they run a September year end, so that was only last week that they announced that, even in the face of challenges.
Okay, so I guess that's interesting, isn't it? Because I remember the UK being a key growth driver for Gentrack quite a few years ago, and now it's everything that we've seen in the UK over the past few weeks. Because I believe it's one of those subsidies that the government brought in when they announced their big, I guess spending and then tax cuts recently in the UK. Was that one of the things was that they were changing the way energy prices would be capped, but also at the same time subsidizing some of that difference. Right? And that's how they were kind of the best of both worlds, right? So I just had a question come through, Rob, which is, and this is actually a good question, I like this generally speaking, is how many red flags would you allow before you might sell a business? Maybe if you use Gentrack as an example, was it just that one thing of them changing their accounting policy?
Yeah, it's a great question. And wow, if I had my time again in many businesses, I wish I stuck to one red flag or I mean, hindsight's a great thing. Or if there was always only one obvious red flag, sometimes the flag might be orange and then you find out later it's red. Excuse my analogy there, but with Gentrack, it was effectively that for us, because it just didn't seem the right thing for the business to do based on the kind of change of strategy and communication that they announced in the past. And then there was it was just a change in profile of the revenue, in the sense that there's a lot of one-off revenue that kind of was brought that fell into one year, then wasn't there in the next. With the capitalization, that was it's certainly the red flag for us required. But in other businesses where we have been, truthfully speaking, where we've had some terrible investments in the past that haven't worked out, generally it's around people. And like I said at the past is, management of small businesses is so crucial. The people factor can be the biggest red flag, but it's hard to kind of know that potentially at the time, and it's only in line that does happen and they accumulate. So look, ideally, long answer to a very direct question. Ideally, in this instance, it pretty much was. In other instances, it certainly hasn't been. But we're trying to improve that, and we learn from our mistakes over time.
Well, that's investing, right? Like, investing isn't black and white. There's a lot of shade of grey. And like you said, some of the key to being a good investor, in my opinion, is understanding the signals and just being aware that you're not going to get it right every time. And that's why I find, Rob, that the people that have been in this industry the longest tend to be the most humble about their investments too, whereas the people that are most excitable tend to be the newest because they haven't been through that yet. But Rob, before I let you go, the NAOS website is a great resource. People can learn about the LICs, some of the portfolios that you manage, and they can also subscribe to a newsletter, right? And there's a particular one. I remember when we caught up in Melbourne not too long ago. It's like, is it the CEO Insights?
Yeah, that's right. Yeah, for anyone out there that's potentially interested, you can go to our website. There's a lot of information there, and including we're actually doing our first time since COVID, our kind of nationwide roadshows starting next week, actually. So if you like or dislike anything I said and you want to come and throw it, egg at me, or you want to hear more, if you liked it, there's a list of all the different places that we're visiting soon. So feel free to share that or come to any of those places should you want to know more about who we are and learn more about some of the businesses that we invest in. But coming to your specific question there, Owen, around what we do is, in terms of every week we send out a newsletter called CEO Insights, which is it's not related to us at all. We're not trying to paint a picture about NAOS. It's simply quotes that we find throughout the week that are kind of industry related rather than company specific, from a wide range of CEOs across your CEOs or directors across the world. People find that relatively interesting to listen to. So feel free to sign up to that on our website. And as I said, we send it out every Friday morning. So we find it a great resource internally as well for kind of keeping up to speed with kind of markets wider as well.
Yeah, I see some of the viewers tonight. Martin and Sally. Sally says, thanks for a great presentation, Rob. But Martin says it's a great newsletter. And I agree with that. Like, it's not, as individual investors, it's very hard for us to get, to speak with management. So just to get a concise thing of what you're reading, what you're seeing, just helps to get a finger on the pulse, so to speak. Mate, this has been a lot of fun. We've got Maxiparts on the watch list. We've got Gentrack on the watch list, both really interesting businesses that have had a really interesting couple of years. And I like that you were very balanced there and honest about, these are big positions for you guys. And you've obviously done a lot of work on it, and that shows through in tonight's prezzo. So, Rob, thanks for taking the time to join us tonight. I really appreciate it, man.
No worries. Thanks for having me on. Thanks to all the listeners. And if anyone's got any follow-ups offline, you can reach me, just either directly inquiries@naos.com.au, and I'm happy to answer any questions you got. So thanks again, and enjoy the rest of your week.
Thanks, mate. Appreciate it. Have a good night. So that was Rob Miller from NAOS. Like I said, it's great to have him on the show. So if you do want to get in touch with him, please go to the website. On the road shows, I think it's great that we can do road shows now that we're, able to get back out and meet people and speak to investors. I think to be honest, I get a real kick out of meeting everyone. And hopefully one day, I don't know if I'm planting a seed here, maybe we can do a Selfwealth live meetup somewhere around Australia, that would be heaps of fun. I'd love to meet you all in person, and we could maybe do this live. That'd be heaps of fun. So thanks again to Rob for joining us tonight. We've got enough time to do our giveaway tonight. So I do have all the list ready to rock, and you can basically just get your guesses in, and we can go from there. So it's been a bit of a volatile week, which I'll close out with in just a moment. But if you want to guess what the most bought and the most sold companies are, please get that into the live chat now. Like, I can't remember who, I think it was Plant One that said, there's not many numbers here tonight. And there's not many numbers here for the live show tonight. I think it is daylight savings. It's knocked a few people around. People are tired. People are still working. People have different things on their agenda. So get your guesses in, please, for the top 5, your number 1 most bought and your number 1 most sold. And you will win, if you get both correct, a pass to the Value Investor Program and some free trades. All you've got to do, if you do win, is email marketing@selfwealth.com.au and be sure to send a screenshot of your YouTube handle, or just make sure that you can prove to us that you are who you say you are. So I can see Jonesy's guessed most bought Pilbara. Most sold Sayona. I like it. So this are ETFs in this week? Great question, Jason. I just saw that. No ETFs this week, because if we did, it would be VAS and VAS. So no ETFs this week. Please, direct stocks only. I think it goes with the evening too. We've spoken to Rob about individual companies. So is it always going to be lithium miners, says Anthony? Well, maybe. Himansu says, buy core lithium. What about your sold there? You've got to give us your most bought and most sold, Himansu. JJ, and good to see you here tonight, Himansu. JJ's guessed most bought BHP, most sold Pilbara. Not eligible for a prize, just for fun. Oh, okay. Well, you're not eligible for a prize. That's new to me. Okay, so Jimmy, most bought BHP, most sold Fortescue, bought PLS, sold Sayona. This is for, I've got a few jokes here on the screen, just to throw you off track. If you read these, they're just to throw you and you think, oh, is he getting inside my brain? Is he trying to give me a tip? Is he not? You can see them here. So without further ado, I'm going to start with, I can see Mike's guessed BHP and Pilbara. I'm going to start with the most sold. Let's bring it up. So how do I do this without giving away my list? Yes, I can just go here. So most sold in at number 5, which is really interesting, is New Hope Corp. I don't know if everyone saw this last week, but coal mining companies were extremely volatile last week. We might be able to see that if we look at the last month. The shares were very volatile last week, huge intraday sell-offs, and then rises a few days later. In at number 4 on the most sold list is Sayona Mining. We've been through this company before. It's a mining, lithium mining company. We've got Fortescue Metals Group in at number 3, company that we have done a deep dive on before. Big dividend payout. Probably dividends coming off a bit. In at number 2 on the most sold list, we've got Whitehaven Coal, continuing with that extreme volatility I talked about last week. Look at that. It's no wonder investors panicked and sold. Some big sales coming through there. Raptor, I can see you've guessed Pilbara for buy and sell LKE, otherwise known as Lake Resources. So here we go. Number 1 on the most sold list, I think this might break a few hearts, is Pilbara. Pilbara in at number 1 for the most sold list. I guess they didn't get the memo last week about lithium when we had Kanish Chugh on the show from Global X. But Pilbara, here we can see, over the long term, it has hit scale. We know that. It's a business that has been very successful in recent times. So we've got, in reverse order from 5 through to 1, we've got New Hope Coal, Sayona Mining, Fortescue, Whitehaven Coal, Pilbara. Now, hopefully I haven't broken too many hearts. Let's get through to the most bought. In at number 5, we've got Fortescue Metals, FMG. We've got, this is going to hurt, LKE, Lake Resources, in at number 4 on the most bought list. We've got Macquarie Group in at number 3. And this is an interesting business. Macquarie has reported a profit for every one of the past 53 years. So if you're looking for a business that has reported profits for the ultra long term, Macquarie is one of those businesses. Let's go down to net income or net profit. Let's see what we've got here. We can see a very sharp, light, like pink pastel color here. You can see the growth over time. Got absolutely whacked in the GFC, mind you, but come back strong. In at number 2, we've got BHP. BHP is the number 2 most bought. That would mean that number 1 is, and I don't know if anyone gets this, I know someone gets Core Lithium. Core Lithium, number 1 most bought, and number 1 most sold being Pilbara. So if you did guess that combination, please let us know. Let Randini and I know in the chat. Congrats to you if you did. Crisp high five to you through the digital, the ether. But in reverse order from the most bought, we've got Fortescue, Lake Resources, Macquarie, BHP, and Core Lithium. Did anyone win? Did anyone win? Pocket Full of Shell says, I love Macquarie. Jumped on that sale price. Yeah, I like it. Himansu, you've got both right. Well, there you go. Fantastic. Oh, that's wonderful. Okay, so perfect. In at number 1, I've got something that I wanted to bring up with you tonight, which is that, guess what? Now that we've had Rob on the show, now that we've had Steve Johnson on the show, now that we've had Kinesh Chugh on the show, I need your help. I need you to help me come up with a list of future guests. So if you have, Jimmy says, 2nd for BHP bought and 3rd for Fortescue sold Consolation. Oh, did we have anyone win tonight? I feel like, did we have anyone win? Because if we didn't, we might be able to go for 2nd best. So you said you guessed Core Lithium. Did you get both right, or did you just get the one right? Let us know. Still waiting on the Musk Selfwealth session, says Jason. Yeah, I am too. Now that he's going to buy Twitter and officially turn it into something called X, whatever that is. Yeah, maybe we'll get him on the show. Maybe we'll be trying to peddle it. Himansu, you won, so fantastic. Good for you. There is a winner, Himansu. Thank you. Please write into us. Congrats, says Randini. Send us an email, please, marketing@selfwealth.com.au. I know, I believe you're a Rask member already, Himansu, so now you've got the Value Investor program to go with that and some free trades. My quote for this week is from Jim Collins, who says, the only mistakes you can learn from are the ones you survive. And I think that's really telling for right now, is that a lot of investors in this volatile market over the past few months have really seen that, the stock market has been extremely volatile. I'm just looking at the A200 ETF, which is basically the ASX 200. You can see stock market is down. I think year to date, the stock market is down about 11%. I've heard from people that bought ETFs last year, and they're telling me, I thought you said these ETF things were good. My ETF is down 10%. This sounds like, is the stock market like gambling? Raptor, you said Buffett would be nice to get a hold of. Now, I'm not sure, Raptor, if you're referring to Buffet or Buffett, but I will take them both on notice, and I will reach out to our friend Warren, and I'll see what he's got for us. I've been actually reading, I don't know if I can bring this up, but I've actually been reading this book. I love it. I started it many years ago, but if you haven't read it already, I think this book is a really good one to read right now, because it goes through Buffett's journey as a youngster and how he was a millionaire by the time he was 30. And this is a long, long time ago. And the reason why it's important to read these types of books now, I think, is when markets become very volatile, we tend to think that the stock market is a very scary place. It will never recover. Like last week, if you asked an investor last week what was going on, their head was like about to explode because it was so scary. What's this thing going on with the Bank of England? There's a recession coming. There's a war in Europe. There's energy prices. The Nord Stream pipeline that connects Russia to Germany has blown up. Like, all of these bad things were happening. And this week, interest rates didn't go up as fast as people thought. Oh, wow, the stock market is a great place to invest. So, I think for most people, reading a book like this, where it shows you, this is from post-depression era, The stock market has done incredible things since then. I think it's important to read a book like that and to be a student of history. Yes, you started, Raptor, you started reading Warren Buffett's letters. That's fantastic. So you can hear just straight from the man himself. Okay, Ethan, you said the guys from Comedian vs. Economist as guests. Yeah, sure. I feel like that would be good. They're great. Aren't they brothers, Ethan? Are they brothers? I could be mistaken. Plant One, you said, what is EML's future? Yeah, I think EML, I'll bring it up on the screen here and so you can see it. EML Payments, the business that's been beaten down a lot recently. EML Payments is a business that does electronic payments and digital payments and these types of things for businesses. I think for the most part, it's been a really hard run for them, Plant One. And I know you know this. I've recommended the company previously, and following the departure of CEO Tom Cregan, it's made things worse. But Emma Shand, I think, will come out with her review in the next 1 to 2 months and basically say, this is what I'm going to do with the business model. This is how I'm going to clean it up. So JJ, you said Dale Henderson from Pilbara would be very interesting on lithium. I would love to get him, JJ. If you do have a connection, please let me know. I did speak to his executive assistant about 2 weeks ago. Dale, if you're watching, please get back to us. We would love to have you on the show. Brenton, you've said, what fun things does Warren do with his money? You know what? I actually has this for a bit of trivia, Brenton, and this is sorry, I just saw Raptor. I just saw your comment. Scott Phillips summed it up nicely. So the ASX is drunk. Yeah. I mean, yesterday the stock market jumped 3.5%, even though interest rates went up. A few months ago, interest rates went up and the stock market collapsed. So that's basically it. That's basically the way things work. But to get back to that anecdote, Brenton, so the one thing that Warren Buffett loves to do, and he doesn't spend money on it, is actually play bridge. And he convinced Bill Gates to play bridge with him, and he does that a lot. But the other thing, I heard one thing when Warren Buffett did an interview many years ago. The interviewer asked Warren to empty out his pockets to show us what's in your pocket, and he just had a bunch of stuff. He had I think at the time he might have had like an Amex or something, and he had a bunch of just like stuff you wouldn't expect to be in the pocket of a billionaire, right? And so I think that's kind of telling. You'd expect a billionaire to have a pocket full of cash, but yeah, sure enough, he didn't. Raya, you've said, how about Rob Milner from Sol? I am down since MLT merged. You know, Raya, I've spoken to Rob Milner. So we've had Robert Miller on the show tonight, but Rob Milner, who's about 50 years his senior, from Washington H. Sol Pattinson, I've had him on the Australian Investors podcast, and he was very generous with his time. I just want you to remember one thing, Raya, that Washington H. Sol Pattinson, which is this company, and I know you know it, but for everyone else, this company has been around for over 100 years. So don't worry about, when I say don't worry, I mean like in the scheme of things, if you're talking about long-term investing, you know, it's only recently in the scheme of things that it merged. So I wouldn't sweat it too much if you're a long-term investor. Simon, you've said the inflation guy, Michael Ashton, if the time difference is not too much to do. I don't know who Michael Ashton was, but I'll put him on the list. And Jimmy, you've guessed Jacob Strassholm or Mike Henry. Okay, I don't know who they are off the top of my head, but I'm happy to add everyone to the list. And if you do have any connections to these people, please reach out to us. Send us an email. But in any case, we better get off the air because it is 7 p.m. Eastern time now. Thank you, everyone, for joining us. I'll be joining you next week from Sydney. I'll be up in Sydney for a week of filming and I'm doing a bunch of other things after attending an event in Queensland. So I'll see you from Sydney next week. In the meantime, it almost seems like the investing world is becoming positive, and it's becoming positive very quickly. So maybe next week we can focus on some long-term investments, some companies that we all know and love. So I'll be back next week. As always, you can find us on social media. I'm a prevalent user on Twitter, hashtag Selfwealth Live. Don't forget to get in contact with us if you did win tonight. And we will see you next week, 6 p.m. Eastern time. Hopefully it's not too bad for folks. Thank you, everyone who joined tonight. Small cap shares are not for everyone, but But if you haven't already subscribed, we'll be dealing with other topics next week. So be sure to subscribe, and we'll see you 6 p.m. next week, Selfwealth Live. Bye for now. Thanks on behalf of Randini.